Hey, good evening, everyone, or good afternoon for some, or maybe good morning. We're going to go through a problem for week number two. So we're still on week number two. This is the last video to be posted, which is actually like a show and tell of a sample problem, right? So I chose the long problem right now, and as you can see, one is actually completed, so it's a comparison, right? But this is the one, Jones Corporation, the one we're going to be answering today. Now, let me make sure we have the premise for this one. So let's read through it. We are doing a so we have financial statements for Jones Corporation and then Smith Corporation. And then there are questions that are qualitative. So, to which company would you, as a credit manager or a supplier, approve the extension of a short term credit and why? And then, would you buy one of the stocks? Why also? So, basically, it's now the application of the theories that we learned this week, how to compute for the performance of a company using ratios, and then are you willing to extend credit, and then which one's actually better? Basically, that's the question, right? So let's go through it. You have the information, which is both the Jones Corporation, a balance sheet. So we have the balance sheet, and then we have also the income statement. One thing that we need to note is that the income statement, there's a plus sign here, includes lease payments. So the selling and admin includes 7,000 of lease payments. We'll show you why it's important for later. And then net fixed asset is used in computing fixed asset turnover. So that's the other one, right? The fixed asset turnover. Because sometimes, or in this case, we showed both the fixed asset then accumulated depreciation. In the PowerPoint slide, you just saw one net fixed assets, which I explained is actually fixed assets gross minus the accumulated fixed assets, right? And then on the bottom is basically Smith Corporation. So the formulas are there already. So if you want to take a look at it, it's actually there, but we're completing only for Jones, right? So let me move the screen so you can see the formula because we're going to be linking it. Now, in your quiz, you're going to be asked the question similar to this one. And then what happens is that you don't have the full formula. You just need to recall it. So make sure to memorize some of the key ratios. For example, profit margin. What is profit margin? So profit margin is basically net income and then divided by sales. So if I do this, net income, I'm gonna let me make sure so follow the cursor. I have net income here, 92,500 divided by, okay, which is actually sales, which is on credit. So basically it's 7.4%. Okay, let me make sure I have my calculator on the side as well. Now, if I have return on assets, so what is return on assets? It's basically net income divided by the total assets that we have, right? So the formula for that one, it would be, kindly hold guys, okay? It will be the return, which is the net income, divided by total assets. Where's the total assets? It's on the balance sheet, which is the 500,000. So we're just linking it out, 18.5%. Now the question also is that how much is the return on equity? We talked about the DuPont method, return on asset, you break it down profitability, you break it down by the efficiency or asset utilization, and you break it down by the financial leverage. We will not do that. We will do the simple calculation, which is net income divided by stockholders' equity. Where is net income? We've always been using that. Where is the stockholders' equity? The stockholders' equity is on the balance sheet side. So do I need to just get the 500? No, because the 500 is both liabilities and equity. And then you have the liabilities here. So sometimes when you look at the Excel file, make sure to check how they come up with a formula, right? So I just need the retained earnings, paid in capital, and then a common stock. What's paid in capital again? It's the amount that's paid by the stockholders in excess of the common stock, which is part of equity. So how do I know I don't need to use 500? There's no formula there. Because 500 is actually the addition of all of these. Or I can do this just to, as accountants, we always try to validate the numbers. So there's an accountant's creed, right? We always say, in God we trust, everything else we verify. That's the accountant's creed. So I know it ties up. So now what I'll do is that return on equity would be net income. I'll link it, okay? Divided by the sum of the following, the three items here. Highlight, close, enter, 28.91%. Now, receivable turnover, and then I have here the average collection period. So I have two formulas. Receivable turnover actually tries to understand how much is um, uh, your receivable, how much movement do you have of your AR to collect it, right? So I need to make sure that the turnover, so it's basically income or income statement account divided by an asset account. I want to make sure that that one is actually like for like. Let me take a look on the sales on credit. It's good. It's on credit. What we talked about before is that sometimes the problem would say 70% of sales is on credit. So you need to make sure you multiply it. This time around, the sales itself of 1.250 million is actually all on credit. So sales divided by, let me look for now the receivable, which is here, receivable. So now it's 15.63 times. Now, it means that it moved faster than 12 months. Sorry, it moves faster than 1 month. So 1 month is 30 days. There are 12 months in a year, so it's moving faster. Remember, that's how we try to analyze it. So the collection period, I need to now calculate it. One way, so we'll do the long way, okay? So the long way would be, I need to have the receivables, right, divided by the daily revenue, which according to the problem, we need to use a 360 days a year, right? So I would say daily revenue would be, let me open parentheses, look for the revenue, but I need to make sure I divide it by 360 days. So it's 23.04. So a while ago, I can spot it already, right? It's faster than 30 days, or it's faster than 1 month. The collection, 1 month equals 30 days, because how many months in a year? 12. And I got the turnover of 15. So it means that it's faster than 12 months, right? So it's like less than 30. Faster than 12 months means that less than 30 days. So computation number one, okay, like that. And then I'll show it. Another way of doing it, which is actually somewhere we're in is actually faster, I'll delete, okay? I would shortcut it by having 360 days divided by receivable turnover, 23.04. I'll do undo so you can see it again. Old formula, 23.4, control Y, new formula. It's the same thing, right? So let me make a mark here. It's basically what we did was is receivable turnover divided by, I'm sorry, it's actually 360 days divided by receivable turnover. And then I'll do that so you know that I just encoded it. Okay. So inventory turnover, same thing. Turnover means that you're using sales as your numerator, something to make sure that you are able to remember it. divided by the balance sheet, which is inventory. So we basically look for inventory, 50,000. So you have 25 times, meaning that it's faster than your norm. Actually, we don't have it on the problem. If you want to compute the number of times that you sell the inventory, you can do it this way, 360 divided by this one. So 14, every 14 days, you actually move your inventory out of your warehouse. It's not being asked, so it should be like the average inventory period. Yeah. So, but it's not being asked, but just in case, want to make sure that you actually know that also as well. Now, so remember when we say turnover, what's the name of the game? It's always about sales and then a balance sheet. Fixed asset turnover will be sales divided by fixed assets, which we know use the net fixed asset when you're computing net asset turnover. So sorry, I just said it, but like I didn't, I did not do it right. So I need to use a 350. So what do I mean? The 350, which is not, there's no formula. I'll do that one. If I sum the fixed asset grows at 500,000 and then accumulated depreciation less it, that's your 350. I'll make sure I do this. So you know that I just added it out. And then of course you always have that thing, ignore the error. Okay. Total asset turnover. Again, turnover means sales divided by total asset. What's your total assets? 500. Because when you add everything here, that's 500. How do I know? So here, sorry, it's here plus this one, because that's the net, right? That's the 500 when you look at the sum in Excel. Current ratio is the formula. It's current assets divided by current liabilities. Do I have current assets? I do have current assets. Current assets, let me check. Yes, that's current assets. What about current liabilities? Do I have? I have liability section. Could I use everything? Not really, because why? The other one is the long term. So it means that this one's the only current liability. So when I do the formula, equals sum, let me add this 3, divided by only accounts payable. So it's 1.5 times. I have, for every dollar of liability, I have an asset of 1.5 to the dollar of liability. It's still okay, but not okay because you only have 50 cents as a buffer, right? Rule of thumb, it should be 2 times. Quick asset, quick asset, quick ratio or acid test ratio. Um, we need now to deduct inventory from the current asset to get the quick assets. So it would be, actually you can do it this way, right? It's a long way. I would add all the assets and deduct the inventory, right? So I'm going to do the bracket for that one. And then you divide it by the current liability. Oh, not like that. Do I actually have a bad number? I have a bad number right now. Kindly hold, guys, okay? Because I have a wrong formula. Let me just do the quick one. I'm just going to add or exclude the inventory already divided by this. Yeah, it should be 1, basically. 1 times, because 50 is the one that you have. That's the 0.5 of the 100,000. So it's 1. Now, debt to total asset. So debt means that it's all the liability, including long-term and current. I'm going to do a sum of the two here, divided by total assets, which we know already. So it's 36%. Now, the times interest earned. So basically, if I'm a banker, I want to know if I'm able to pay the interest expense. So it's going to be operating profit, or basically earnings before interest and taxes. Let me make sure we actually explain that. the earnings before interest and then taxes is also called operating profit because profit is earnings before interest expense and taxes, operating profit. Operating profit is actually right before, right? So that's another way of description wise. So operating profit divided by interest expense, which is this, and then it's 24.13 times. Now, what about the fixed charge? Fixed charge is so fixed charges are basically those that includes interest and others such as leases. Remember we have this one. This one, the one with the cross sign, includes 7,000 in lease payments, which is actually which one? This one. The admin expense, selling and admin expenses include lease payments of 7,000 here. So what happens now is that if I use operating profit, it got deducted with the 7,000, so I need to add it back. And then the charges is the interest expense plus the 7,000 that's actually in here. So I need to add it also. Okay, what do I need now? Let's do it this way. I need to get the operating profit. I did brackets, right? Open parentheses. I need to add 7 because it's not there. I'm going to add it as is, which we know is the lease payment divided by bracket again, the interest expense, the plus the 7,000. And then basically it's 13.33 times. So we computed it. I did not take out the type information here. So let's go through it. We just go there. As long as we can see both. So to which company would you, as a credit manager or a supplier, approve the extension of the short-term credit? Mostly companies or vendors are concerned about liquidity ratio. Remember, if the company is able to pay the vendors, and then Smith Corporation would get the nod as having the best in this ratio. So let's take a look on liquidity. Liquidity are basically this ratio, right? You have 2.5 for every dollar of liability, you have 2.5 of assets, current assets, which is good. For every dollar of liability under Smith, you have 1.5 of quick assets, which is better compared to Jones. So one could argue that Smith has benefited from having its debt primarily long term rather than short term. Let's take a look at that one. So this is long term debt for Jones, and then you actually have Smith actually 210, and then they have less payables also. Yeah, so compared to Jones, which is 100,000, Smith only has 75,000. Okay, but of course that depending on how you manage the business, right? And then depending on, I would say they're the same industry, but there are a lot of external and internal factors that affects it. But for me, my practical answer, there's always the two things, right, in accounting. Um, a technical answer and a practical answer. The practical answer comes when you're practicing accounting, right? So if I'm a vendor, I would still not just I would still consider Jones and not just say I don't want to extend business to him. I want to know if they're able to pay. Let me start them off with 3 months of cash on delivery, or maybe 2 months if they wanted to, if Jones is haggling, right? And then after that one, if they're able to show that they're able to pay me on time, then let me extend them credit, which is 30 days. And then let's see how the long-term business goes, relationship-wise. So there are other ways of doing it, strategy-wise. So technical answer, I will go with Smith. Practical answer, I will still go with Smith, but uh, I will just not push Jones on the side. So just want to make sure we have that practicality in mind when looking at numbers as well. There are both qualitative and quantitative. So both needs to be considered. As a strategist, in the future, you need to understand the numbers. That's where accounting and finance comes in. But as a strategist, you need to calculate your risk, business risk, operational risk, business risk, technology risk, financial and compliance risk. And then from there, okay, let me make a business decision. So that's why a lot of people would say if accountants would actually be a CEO or a CFO, they might be risk averse, right? I'm very cognizant, I'm very conservative. But if you don't have an accountant as a CEO, they might just be too much of risk taking that your financials will not be healthy. So you need to be in the happy medium. Let's now take a look on in which one would you buy the stock? Why? So, of course, shareholders, different hat, different point of view, shareholders, not vendors. Shareholders are concerned with profitability. In this category, Jones has a better ratio than Smith. Let's take a look on profitability. Ah, definitely. 7.4 against 5.25. And then the return on assets, 18% compared to 12. Return on equity, you can always recover equity later on, right? So, but it's showing that they can perform better than Smith. Um, so Smith does have a high return on equity, but this is due to much larger of a debt. So what happened is that return on equity for Smith is actually higher because of a higher debt. Let's see, 180 here on Jones. Let's go back here. You have, oh yeah, you have 300, 380, 285 over here compared to 180. So return on equity is net income over stockholders' equity. Asset equals to liability plus equity. If you have a higher liability, it means that your debt, because it needs to be constant with assets, right? Your equity will be smaller. So your divisor is smaller compared to your numerator, which is net income, return on equity. So your formula will be higher, or the result of the divisor, or not the divisor, but the dividend that would show, or the solution would show a higher number. So sometimes it's about the math. That's one of the things that you need to consider. It doesn't mean that it's actually, is it really an operational ROE? They generated a good ROE because the strategy that they deployed, or is it because it's just so happened they have a different financing structure, or maybe a company is very cognizant on the way that they want to strategize on how to finance businesses, and then having loans or having debt is sometimes healthy for ROE. That's why ROE, as we discussed on week one, is not the only sole way of doing it, right? Just wanted to make sure that we understand that. In terms of other ratio, Jones had, let me just move it up, okay. So in other ratios, Jones has its interest and fixed charges as well as its long-term ratio looks better than Smith. So, uh, but when you make decisions, practical side of things, you need to actually consider a lot of things as a shareholder. And then I would say that if you think that you have enough funds um, as a shareholder, and then I would say, okay, let me just give like, for example, shareholder wise, you have enough funds and your expectation when you go to the market or when you make your extra funds invested on the stock market is 15%. At 15%, if I invest the money to Jones, normally it will be 18.5 is the return as a shareholder. I might want to go with Jones. But remember, Jones may pay or not pay you dividends depending on their dividend payout policy compared to the stock market at 15%. So now there's a lot of things that you need to weigh as a shareholder. And then you might want to just say, okay, I have way too much extra money. I It doesn't matter. I just needed to invest, and then I'm willing to take a risk compared to the stock market. I'll just go with Jones at 18.5%. Why is it also risky to go to Jones? Because Jones um, may or may go bankrupt, right? But the stock market is a diversified equity. Say you're doing an equity index on the S&P 500, so there's a lot a lot of diversification, and the average return is 15%. So there's a lot of things to consider, and I know I'm throwing it out to everybody because I wanted to make sure that by the end of the term, we will touch base everything that we've talked about, and then I'm introducing concepts here and there on the practical side of things, so you can actually see it. Now, finish videos 1, 2, and 3. This is the third one, and then from there, um, we have exercise, we have quizzes, and then there's like 4 tabs on the quiz. You would need to upload it on the Canvas, so I would grade it manually also. Okay, so make sure to actually read through the materials this week, and then also watch the videos, watch the solution, and then um, do your quiz. Okay, so thank you everyone. Have a good weekend.